Your 401k may actually be keeping you broke. Now, before half the financial advisors on YouTube come after me, let me explain what I mean. Because I'm not saying a 401k is always bad, and I'm definitely not telling you to go cash yours out tomorrow. But if you're a business owner like me, maybe a high income earner like a physician, I think there's a legitimate question you need to be asking. Is putting as much money as possible into a 401k actually the best strategy for building wealth? Because I don't think it always is. Now, about 15 years ago, I started looking at money differently. Instead of asking myself, where can I put this money to get the highest rate of return? I started asking, where can this capital reside until I need it? Now, that's a very different question. I wanted a place where my capital wasn't locked up, where it could compound continuously at relatively conservative bond like rates, but where I could also maintain access to that capital when better opportunities came along. I invest in real estate, private investments in businesses and syndications. I wanted whatever it might be, I wanted that money available. And that shift completely changed the way I started to think about money because I stopped thinking about just rates of return and interest rates, and I started thinking about control, liquidity, and how many different jobs I could make the same dollar do. And that's why I want to give you 3 reasons I think putting too much money into a 401k can actually be slowing down your ability to build wealth. The first one is that it separates you from your money. Think about what happens when you put money into a traditional 401k and you get a tax deduction today, which is great. But in exchange, you're agreeing to play by someone else's rules regarding when and how you get to access that money. And you're also agreeing to pay taxes when you eventually take that money back out. People sometimes talk about a 401k as if it's a tax-free thing or they're avoiding taxes. You're not. You're just punting them. You're deferring them into the future. And that's a huge difference. You're basically saying, I'll take the deduction today and I'll settle up with the government later. The problem is you don't know what your tax rate's going to be later. And neither do I, and neither does your accountant. So you've got a silent partner in that account, and you don't know exactly what that partner's share is ultimately going to be. Now, again, that doesn't make a 401k bad in itself. If you've got a great match from your employer, I'm certainly not telling you to walk away from free money. And for someone who isn't going to save unless the money automatically comes out of their paycheck, a 401k can be a very useful tool. Where I tend to disagree with conventional financial advice is this idea that every single dollar you can possibly stuff into a retirement account automatically belongs there. Because once that dollar goes in, you've given up a lot of your control over it. And control has immense value. Number 2 is liquidity. Now, if you're a business owner, you already understand that liquidity is like oxygen. You can make $1 million a year, you can have tremendous net worth on paper, but if you don't have access to capital when you need it, you can still be broke. And I don't mean broke in the traditional sense. I mean opportunity broke. You've got wealth, but you can't efficiently use it. And retirement accounts aren't the only place where this happens. Your house is another great example. Somebody may own $1 million house and only owe about $300,000 on it. On paper, they've got $700,000 in equity. Sounds fantastic. But what is that $700,000 doing today? It's not necessarily earning a return simply because it's sitting there as home equity. And if you need it, you got to go sell the house, or you got to go convince a bank to let you borrow against it with a HELOC. Now, I'm not saying you should strip all the equity out of your house. That's not the point. The point is that I want you to start recognizing dormant capital, and it has a cost, because we've been trained to think that the goal is simply to accumulate assets and pay off debt. Now, I think the better question there is, how efficiently is my capital working? That's the question I started asking myself about 15 years ago, and it led me to build what I think of today as a capital system. I wanted a safe place for my capital to reside where it could continue compounding at conservative rates, but also remain accessible so that when a better opportunity came along, I could deploy it there. And over the years, one of the tools I've used to accomplish this has honestly been properly structured whole life insurance. But that's not really the point of this video at all, because there are so many different ways to think about liquidity and capital storage. The bigger idea is this: I don't want my best capital sitting somewhere that I can't get it when an opportunity knocks, because life requires liquidity. You need money to buy a house. You need money to buy vehicles. Your business may need capital. You may have payroll coming. Real estate may go on sale, or somebody may approach you with an opportunity to buy a business. A great private investment may come along. And when those opportunities arrive, I don't want to have to say, I'd love to do it, but all my money is locked up. So that brings me to number 3, and that's that your 401k can absolutely blind you to Main Street. This may be the biggest one, honestly. The 401k has made investing incredibly easy. Put money in, pick some funds, keep contributing, check the balance every now and then. Don't think too much about it. There's something to be said for that simplicity, but I also think that it can make us financially lazy, because some of the best wealth building opportunities I've personally ever seen were not sitting inside a mutual fund. They were on Main Street. Real estate, again, private businesses, private credit, making loans, syndications, or buying or growing your own company, or maybe investing alongside a friend who wants to start his. These are businesses and assets that you may literally drive past every single day on your way to work. Once you start looking outside of Wall Street, you begin to realize just how much of the American economy exists outside of the stock market. Now, I want to be crystal clear. Private investments absolutely have their risks. They're often illiquid, they're harder to evaluate, and you can absolutely lose money there. Now, you've got to know who you're investing with and what you're investing in. But that's part of becoming an investor instead of just becoming a contributor. Those are two very different things. Now, if every investable dollar you have automatically goes into a retirement account, you may never develop the liquidity or even the habit of looking for opportunities outside of it. Now, I've personally invested in real estate and private credit and private equity and operating businesses that I couldn't have taken advantage of if all my capital was locked up inside of a traditional retirement account. And this is exactly why I think business owners and high income earners like you especially need to reconsider some of the conventional wisdom we've been taught. Again, I'm not anti 401k. I'm just anti 401k is the only answer. And there's a huge difference. Maybe you take the employer match. Maybe you use a Roth strategy. Or maybe you own some real estate on the side here and there. Maybe you maintain a pool of highly liquid capital. And maybe you learn how to use high cash value life insurance. Maybe you even invest in a private business. Or you can do all of these things. The specific tool isn't the point. The point is that you need a capital strategy. I want my money positioned so that it's doing something today while still remaining available for something better tomorrow. That's the key, because wealth isn't just about how much money you can accumulate. It's about how much control you maintain over your capital and how efficiently and quickly you can deploy it. So here's something I'd encourage you to do. Take a look at your own balance sheet. Look at your 401k, look at your IRA, and look at the equity in your home. Look at the cash sitting in bank accounts that's sitting there idle. Look at your business and ask 3 questions. How much of my capital is actually accessible? How much of it is actually working? And how much of it could I safely deploy if the right opportunity showed up tomorrow? You may discover that you have a lot more wealth than you thought, but a whole lot less usable capital. And that distinction matters. The financial strategy that we've been taught our entire lives isn't necessarily wrong. I just think it's incomplete. If you enjoy conversations like this about capital strategy, alternative investing, private markets, and just thinking differently about how we build wealth, hit the like button, subscribe to this channel. I'd love to hear your comments below, because I'm going to keep challenging some of these financial conventional wisdoms that we've all been taught, and I'm going to challenge those, and I'm going to be sharing strategies that I've personally used to build a more flexible capital system. So thanks for watching, and I'll see you on the next one.